But certainly amongst really society, the affordability crisis, the challenges behind real estate, it is something that people talk about. And as such, quite often there is dialogue which is just incorrect when it comes to real estate. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to myth bust. Yes, we're going to be myth busters, just like the show. It's time to dig into some of the conversations that quite often rear up. Our coaches recently did a myth busting session. I thought it was good. Shout out to Fadi and Jared. Myths play a big role in determining people's decision making. And quite often there are myths which really derail property investors. So we're going to dig into that today. I think it's a worthy podcast of the Urban Property Investor. But welcome back, regulars. Play the program in double speed, get your life back. And all the episodes I've done are actually lessons on real estate. So feel free to check out those lessons. But when it comes to property investment, there is certainly some conversations people tend to have. In Australia, property is very much a bit of a sport. Most people, if they went to a dinner party, tend to talk about the cost of real estate, the problems of real estate, the affordability crisis. Very much is on just about everyone's mind, real estate, a lot of the time. If you put sort of 10 people in a room and you create small talk, it's where do you live? What do you do? And of course, quite often the conversation leads to trying to get ahead in this world. Certainly in the circles I kind of mix in, there are lots of conversations around real estate, probably because I've always been in real estate. But certainly amongst really society, the affordability crisis, the challenges behind real estate, it is something that people talk about. And as such, quite often there is dialogue which is just incorrect when it comes to real estate. And so myths come from really just the idea that ideas spread, and not all ideas are actually accurate. And of course, quite often myths are perpetrated by, for example, people in the industry, or perpetrated by the media that really come up with all sorts of versions of clickbait, the idea of just, getting something out there, whether it's accurate or not. So the industry plays a role in myths, and certainly myths stem from also behavioral finance, from who we hang out with, the knowledge they have, the feelings they have around certainly different topics. And of course, one of those big topics is real estate. So it's not uncommon to go to a barbecue and talk to a friend, and of course, they will give you all sorts of opinions on real estate. And quite often opinions are just that. They're not actual facts whatsoever. They're just a belief mechanism someone carries. And we all carry different biases and anchor onto different beliefs. But when it comes to real estate, there are really some common myths that we tend to see a lot when it comes to coaching people with real estate. Really, one of the first myths is there is one Australian property marketplace. And of course, this is an absolute myth there is not one Australian marketplace. There are multiple marketplaces and markets within markets, and in those markets, there are even sub-marketplaces. Probably one of the big lessons around real estate is quite often very niche. Now, certainly in Australia, there are 20 bigger cities with circa 100,000 odd population, and each of those cities has different cycles. The cycle of Melbourne is very different to the cycle of Perth, and Perth's cycle is very different to the cycle of Brisbane, and Brisbane's cycle is very different to the cycle of Geelong. They're all different, and they're all going through different economic puzzles. Some puzzles are pretty obvious. Other puzzles you need to dig as a researcher on where to invest a few layers into the puzzle itself. But there is no such real thing as one Australian property market. Certainly from a cash rate perspective and what the overall economy is doing, there is a connectivity to the cost of money across one Australian property market, i.e., what it costs to borrow money. But when it comes to property cycles and what is happening in a different area, there are all sorts of marketplaces. Now, you could use a place like Brisbane, for example. You've got the city of Brisbane. You've got the river suburbs of Brisbane. You've got the suburbs of Moreton Bay. You've got the coastal suburbs of Redlands, and you've got the inland territory of places like Logan and Ipswich. They all have different things happening within them because they're all governed by different local councils that are activating things differently. So even though Brisbane's going up in value, you potentially could get more growth in one pocket over another pocket. You can also look at urbanization as a way to look inside a city. You've got high growth corridors around train lines. You've got the inner ring, the middle ring, the outer ring. And then you've got sort of areas which Bernard Salk calls the scrambled egg city effect, where you've got a lot of growth typically in housing and property around job centers. And of course, the idea that people like to live 15 to 20 minutes from job centers. So there's all sorts of things happening inside of the real estate marketplace. It can even get down to a street level. How many properties are on a street? How many properties get resold on that street? Is it a tightly held street? Is it a street abundant of real estate? So again, when you're listening to people about the property market in general, probably what they're really commenting on is the economy, which is the conversation piece. They could be commenting on, I wouldn't buy a property now in the Australian property market because interest rates are, higher than they have been, 3 years ago. That is just, again, needs to be compared to what? Compared to where? Everything needs to be fact-checked, but certainly when it comes to a property market, there are multiple marketplaces. There's the apartment market, the housing market, the townhousing market, the new property market, the established property market, the luxury property market. There are so many different marketplaces, and that's why it's very difficult for people to become really an expert of an area, because quite often investors are investing outside of an area. What side of the road is the better side of the road? Which way is the best way to face in a street? Where is their influence on real estate coming that is going to create a downward pressure on real estate? So really, there is no Australian property market, and there are certainly more advantageous times to buy in certain cycles within property markets. there are marketplaces rising in value as we speak. You could simply buy real estate in that market and it will go up in value. There are marketplaces going down in value. There are marketplaces which represent really good buying at the moment. So myth busted. There is no Australian property marketplace. Now, this myth is something that frustrates a lot of novice property investors, that property increases in value every year. And of course, it does not increase in value every year. In fact, the property cycle, if you like, is quite often around growth spurts. You might have 2 to 3 years of significant movement and then 4 to 5 years of very little movement whatsoever when it comes to property prices increasing. So it definitely is a bit of a myth. You will not get a linear effect of real estate going up every single year, year on year. And of course, that meddles with people's psychology. Quite often, human beings need to see results to validate decisions. And real estate is not like the share market. It is not a market which you can see results day by day. It's just not designed to do that. It's actually designed to be a very slow moving beast where you buy something and you make the decision, you make the right decision, and then you create a decision around property investment as a time horizon. Now, remember, time horizons are a big important factor with real estate. Now, it's quite often said that real estate will double every 7 years. It does not do that. It can do that, but the Australian average is more like around 16 years for dwelling values to double in price. And of course, there is a rule in Australian real estate known as Rule 72, which is just really taking the capital growth rate an asset is capable of achieving and multiplying it using Rule 72, which is basically how quickly the real estate can double in value. A 7% annualized capital growth rate would see real estate double in 10 years. The challenge is that real estate over a 10-year period may do nothing for 6 years, go sideways for 1 year, or even down in value for 1 year, and over 3 years double. And of course, sometimes you can get lucky basically jumping into a market just before that doubling of value effect, which comes along, and you feel like an absolute genius. But in actual terms, depending on where you measure the start and finish line, really real estate is a much slower moving beast than that, and it does not go up every single year. In fact, it can go down in value. But the beautiful thing with real estate is even if it goes down in value, you don't get margin called. The bank doesn't ring you and say, this property is worth less than what you paid, you need to pay the difference. So time in the market allows for the real estate to do its thing. Now, I tend to look for real estate that can double using Rule 72, using a 5% growth rate, a 6% growth rate, or a 7% growth rate. And it really depends on people's budgets as to the type of growth rate they're typically going to get. If someone's going to buy in a tightly held marketplace where there's, really, exciting pieces of real estate, they're probably paying a fair bit for that, but will get a faster rate of growth than someone scraping ends meet together at the bottom. But don't let that stop you. The growth rate of 5% is still competitive and will get you equity over time and propel your wealth forward. When I started investing, I bought some very basic level real estate. As I've gone through the decades of investment, I now own luxury real estate. It is a journey. It is really a journey. And of course, the next myth is that property investment is fun. Well, no, it's not fun. And I can attest to this. There's a lot of work behind it. And that effort quite often gives people a lot of anxiety. And again, I think it's portrayed sometimes as this, this easy process that, is just, as simple as, just borrowing some money and you'll become very, very wealthy out of real estate. It's not fun. There are problems to deal with: vacancy rates, issues with insurance, things cost more, strata levies go up, council rates go up. There are, all sorts of challenges. Cyclones happen, floods, you name it. Real estate and the ownership of real estate is not a fun experience. There's a lot of paperwork. There's a lot of conversations that need to be had. There's a lot of time that goes into being a property investor. And again, that's just the reality of life. So it is definitely a myth to say that, property investment is a bundle of laughs. It's not. And really, it's not meant to be. It's just meant to be a financial outcome. Real estate is just a part of creating a financial outcome. If you could get the same result and same leverage with buying emus, you would buy emus. If you could borrow 90% on an emu and it could double in value at a 7% growth rate, and there was a lot of evidence around that, we would all be buying emus, or emu eggs. It was a big thing once, emu eggs. But in real estate has a proven track record, but it is not a fun investment concept. You can make it fun, and I try and make it fun. I do fun property tours every now and then. In fact, last week I was showing people some golf course fronted luxury homes on Greg Norman, on one of Greg Norman's golf courses, and we were driving buggies. We had a little a buggy chain race going on a golf course. That was fun. That was great. We all had a great time on the golf course. But in general, other than doing a buggy ride across a Greg Norman golf course, there is quite often it's not fun whatsoever. Myth number 4 is a big one. All properties make good investments. And I think this is the one that really meddles with people. Quite often, obviously, we leave school without any real formal understanding of investment. And so we're kind of at a disadvantage because we're not taught any of this when it comes to what next. And of course, then we get into a place where we're quite often trying to acquire an investment to get going. And all sorts of thoughts start to go through our head. What can we afford? What areas do we know? Should I buy a new property? Should I buy an old property? I just saw something on TikTok and it said, don't do this or do that. And then all of a sudden we get ourselves in a position where we basically buy a property. And our belief sometimes, particularly when we're getting going in real estate, is you just get into the market and, good things happen. I've got the lashes on the back from doing that strategy. And I can tell you, getting into the market and, not understanding what the growth potential of real estate is flawed. And I've certainly done that to my own portfolio before, full of enthusiasm. You couldn't knock my enthusiasm. I was very enthusiastic, but didn't look at the future growth potential of real estate, didn't look at the numbers of real estate, didn't look at the cash flows of real estate, didn't look at the add value strategies with real estate, just got into the property market, bought a fairly ordinary piece of real estate, and then watched the repair bills come in. I can tell you, when you've got a pretty ordinary piece of real estate with lots of repair bills coming in, the capital growth rate on it is not exactly exciting. So all properties do not make good investments. There are plenty of dud pieces of real estate. And in real estate, we often call this market lemon theory. Market lemon theory is really the idea that consumers don't know the difference between good real estate nor bad real estate. And so a lot of bad real estate is transacted time and time again. And what you'll often see in Australian property is an investor selling to another investor because really the local market does not want that real estate. And really what is happening is the trade of lemons, the lemon trade. An investor basically can't offload their investment, so they find a greater fool to come along and sell that investment too. Now, there are different categories of what I would say make ordinary investments. There are all sorts of properties. Some of them are brand new properties. There's heaps of brand new properties which are effectively market lemons. They are poorly designed in the wrong part of town. There are plenty of old property as well, which are heat leakers or going through economic obsolescence when it comes to their look and feel. They're in streets and neighborhoods of lower socioeconomics. There are lots of properties which are hazardous. They've got hazardous materials connected to them. They've got things like asbestos. There are lots of properties past their use by date. So what happens to people is they tend to shop on a budget, they shop on a belief, and they see something that's within their budget, within their belief, but actually the real estate they're buying has no real economic future to it, no rate of growth. Now, the rate of growth that people end up with a poor investment can be a capital growth rate of 2 or 3%. Using Rule 72, if you've got a capital growth rate of 2 or 3%, your real estate's not doubling for 25 years. That's way too long. That's multiple property cycles. That's wasted opportunity. And again, with the right approach, you don't need to put yourself in that position. And even people on a budget can still find a good growth rate of 5% on the right asset. Obviously, if you've got a higher budget, typically everything is built into the price in Australian real estate, so you'll probably get a higher rate of growth if you can spend more. And of course, this leads us to the next myth, and quite often, really, this myth is often passed on to us by family and friends who kind of have the caring nurturer type. Don't invest, invest only in your comfort zone. And, Tab at my work's got a great saying, comfort equals dying dreams. And it's so true. We meet all sorts of people and they really just want to sit in a comfortable bubble. But again, probably going back to market level theory, if you don't sort of push the envelope with investment, you're not going to get the right investment, particularly with the challenge with Australian real estate, where really on average, housing today is close to $1 million. That's what people are paying to own a property. So, if you're buying at $200,000, you got to ask yourself, why has 27 million other Australians not paid more for that real estate? It might be in your economic comfort zone to do that, but is that the right decision for you? How can you get outside of your economic comfort zone? What do you need to give up to move forward and get out of your economic comfort zone? And that could be borrowing more money than you expect to borrow. That could be investing outside an area where you grew up. That could be actually investing interstate in an area which you're less comfortable with. You can become comfortable with it. That just requires effort and research. But quite often people sit inside their comfort zone and it creates a dying dream. Now, when I bought my first property, I invested in my comfort zone. In fact, the reason I bought the property was and I was quite young at the time, my parents lived 5 streets over. And I thought, you know what? I'm just going to invest in my comfort zone. I'm going to invest in an apartment close to where my parents live and my friends live. The comfort that was my community. I thought, oh, yeah, I'll do it that way. Now, of course, when I invested, it was probably the worst time to invest in that community. And I used the logic of comfort to invest in a community which wasn't mathematically the best time to do that. Had I taken my money to an uncomfortable marketplace, which had better mathematics and growth potential, I would have compounded my wealth much faster. And so be careful of investing in your comfort zone. If you know something, you create a belief around it, and then that bias can anchor you to not only a good outcome, but quite often a bad outcome. And that's real estate. Real estate is driven in a cyclical nature. And of course, quite often you just have to push yourself outside your comfort zone. And that means sometimes going against the crowd. Quite often, real estate investors use a lot of belief of other people to invest. And of course, that's an interesting paradigm to be. That is really almost, a real dynamic which you have to be very, very mindful of. Is the crowd actually right? Is the herd running in the right direction? Herd behavior is an economic phenomenon in Australian real estate. And if you're running with the herd at the right time, you can do pretty well. But if you're at the back of the herd, you can be very late to the party. So just be very mindful of herd mentality when it comes to real estate. And we often see herd mentality, particularly with lower price point areas. And remember, the Australian real estate world and many markets inside the Australian real estate world have done pretty well over the last couple of years. But there has been many, many periods, economic periods of real stagnation in areas which today are considered very, very interesting to people. And the herd likes it because they're affordable. But just be mindful that quite often the herd can be wrong. The herd can be wrong. Now, back in 2010 and 11, the herd, which is a lot of property investors, was buying in marketplaces that had a lot of association with mining and really small little places in the middle of nowhere. And people were running to buy these investments. The herd was shopping. And unfortunately, the herd was wrong. The herd was wrong. And a lot of those marketplaces didn't go down by 10%. They went down by up to 80% in value. So just be mindful that real estate is quite often driven by herd mentality, and that can really push you into places where there is a lack of fundamentals. Remember, the fundamentals with Australian property is really that pie principle: population, infrastructure, and employment. It's what we're really looking for. Probably the other myth that is quite often portrayed in the Australian property market is that cash flow is the be all and end all of investment. Now, cash flow is important. You obviously have three pieces to the puzzle to fund a property. There's you and your wage, there's the tax man, and there's the renter. Obviously, if the tax man and the renter can do the lion's share of the payment for the real estate, then that's great. But really, the way to accelerate wealth is through growth. And again, like if I've seen a lot of people over the years get really hung up on buying a property where the rent really takes care of everything and you do not and sacrifice capital growth. And I've got real examples of people going, well, look, I'll spend $10,000, $15,000 a year owning a property, and 5 years later, that property's gone up $1 million. So it's cost them, 50 grand to make $1 million. So they're net up $950,000. And then I've got other examples, real evidence-based, of people spending the same amount on real estate, but the rent covering everything. And years later, they basically have made nothing. The rent has basically paid for the cost of the property, but there's been no capital growth. And yes, they've ended up with $20 a week in their back pocket from the rent, which covers the expenses and the mortgage, enough to go to the movies and buy a popcorn, but it has created no substantial wealth in their world. The real estate has not grown because it's not a growth piece of real estate. Now, remember, in property, there is high growth real estate, there is low growth real estate, then there is high cash flow properties and low cash flow properties. Quite often I teach the concept of total return. You want to have a decent rental return, something which is perhaps 4%, 5% as a gross return, but then lean into a capital growth rate, because the capital growth rate will create you chunks of wealth. And again, cash flow is important. It does sort of help balance the book, so to speak. But what's more important is to create capital. As a capitalist, your job is to take money, put it into the market, and watch it grow. And doing that is really, really, really important, because the more your real estate grows, the more you can redeploy capital and own more and more real estate. And quite often that allows people to eventually end up in a place where they have not only growth, but if you hold real estate long enough, you will see rental growth unfold as well. And quite often it's about buying a negative cash flow property, getting capital growth from it, and watching it become neutral cash flow or positive cash flow over a decade or more. And that's just the game. Remember, the game of Australian property, in my viewpoint, is where is the lifestyle tenants and the growth properties. Lifestyle tenants have high disposable income and will be able to pay more rent over time. Probably the next myth, which I think is a worthy one, is really a lot of investors tend to shop on interest rates that are low. And really, when they're putting their puzzle together, they're deciding, again, how to play this game called real estate. And quite often, they will choose a very, very low rate with a lender just because they, again, want to sit inside some sort of comfort zone. And, like sometimes it's about paying 0.5% more and you can borrow a bucket load more money just by actually changing lender. Yes, some lenders will charge more, but lend more. And that lending actually allows you to buy a better quality property with a better rental return and rate of capital growth. So don't shop just on interest rate. It's a bit of a myth to do that. And again, a lot of people I see, particularly parents trying to help their children, quite often they'll say, look, I was just at the local ABC bank and they've got a great rate. I've been banking there 20 years, go down and see the bank manager. They've got a great introductory rate and should be able to get you a property loan. And so what happens is people see the rate and look at, websites and so forth and see it's really quite competitive. But what they're missing is real estate is a game of leverage. How much leverage can you get into the marketplace? And again, that could mean you go outside of your comfort zone and borrow more money, but you're buying a better quality property in a better quality location and even quite often get a much better rental return by doing so. The next myth is good debt versus bad debt. Good debt versus bad debt. Well, actually, the myth is debt is bad, and people will often hold you back in this world. Quite often, even your friends and family will see that you're growing and say things like, don't take on any more debt. Just, pay off debt. The system was designed for you to, let's face it, the system's designed to be a sheep. You go to school until you're 18 years of age, you become a taxpayer, you borrow money off the government through HECS, you go do a degree, you now owe the government money for a degree which, typically shows, an employer you're capable of doing something for 4 years, but quite often most people don't use their degree on the job they end up getting. And of course, you're designed just to pay tax, borrow some money, get a car loan, and even just buy a family home, which is considered bad debt. But quite often people will associate that bad debt as is bad debt because it's got no income behind it. It produces nothing, so that's why it's considered bad debt. But of course, not all debt is bad, and that is the conversation piece. Not all debt is bad. Debt is good. Debt is great. Debt allows you to get ahead in this life. It's very difficult for someone to save themselves wealthy. It's very difficult for someone to earn enough money through a wage and end up in a wealthy state. It's very difficult for people to end up wealthy just paying off the debt of their family home. A lot of people end up asset rich but cash poor. And again, really good debt, which is not debt which is bad. Good debt is debt which allows you to create income. And that income can be created by chunks of capital growth. And eventually the assets that you create through income generation can spit out cash flow. That's the game we're in. So debt is not bad. Debt is actually good. And really, the younger you are, the more time you've got. So load up the debt, I reckon. Obviously, as you get closer to your older years, it's quite often, it's how you manage debt, which is the important thing, which takes me to the next kind of conversation piece. I'm too old, or is it too late to invest? Which is, again, another myth. Now, really, if you've got nothing when you're 64 years of age and you haven't got $5,000 in the bank, it's going to be probably too late to invest. But if you put yourself in a position to where you've got a few bob saved up, it's generally not too late to invest later in life. And people will go to their grave as investors. Now, I'll give you a story. I mean, my old man, he at age 75 borrowed money to buy a small block of flats. And, he got sort of 50% leverage on a small block of flats. And today, those block of flats are spitting out some serious cash flow and have gone on to sort of double in value. So it's not too late to invest. It certainly wasn't too late for the old fella Cole, my dad, but it's never too late really to invest. What becomes too late is if you don't plan for your retirement, if you don't take the steps to do something about it. So definitely, the younger you are, the more wiggle room you've got. The older you are, you just better get into it. That is for sure. We all grow too old too early and too wise too late. So get into it if you're starting to see the grey whiskers on your face like me. Make sure you keep chugging along. There's another property cycle out there, so let's all go do it. And don't underestimate that. There is often, a feeling that Australian real estate can't possibly do more, but we're already seeing the signals, particularly off the last election, federal election, that, the bottom end of the market, that sort of $1 million home is not far away. There's obviously going to be a lot of pressure at the bottom end of the market, with first home buyers being encouraged to get into the market and create themselves home equity. So we know there's going to be growth around the corner, and certainly if you can get a piece of that, no matter how old you are, that's the game. All right, folks, that's it from me. I hope all is well your end, and we'll talk again soon as we dissect property. See you. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.